Management. Aishwarya, good afternoon. How would you sense the market construct ahead of the earnings season? We have seen a long streak of correction followed by some reversal at this stage, and today also it marks for the fourth consecutive day of gains for the Nifty as well.
Good afternoon, everyone. Obviously, we have seen some respite. In the last 4 days, there has been some reversal in the trend, which was visible over the last later part of the September 2025. But I believe the only reason which has led to some sort of improvement in market is possibly, in our understanding, the update of many of these banks, both private PSUs and some of the medium-sized banks, where the credit growth number quarter on quarter came anywhere between 4%, 5%, 6%, where the expectations were little muted. And on top of it, when we witnessed the kind of festive-led and GST-led selling happened in two-wheelers and four-wheelers, that provided some sort of impetus to the market that things are not all washed out. So I think that is what we are trying to see, the some sort of movement or reversal in the market in the last four session or so. Now, if we go ahead, I believe what will really dictate the terms of the market is possibly, as you said, the quarterly season. And we all know that expectations are pretty muted around it. So if we see that the result season basically meets expectations or even reasonably beats it, the probability is low. I believe it will give the support to the market. But overall, I believe, the trend of the market will only depend on the way the India and US relationships will play out in the coming month and also on possibly FI trend. So we all have seen FI has been selling, but I want to bring a very important point that this calendar year, 25 YTD, we are closing to almost $17.5 billion of FIs being sold in Indian market. And this is the highest ever, Loisa, which we have witnessed so far in the last many years. In 22, we have seen this number when your Fed started doing changes in the interest rate. We saw almost 16, $17 billion of outflow, but then the reversal happened. So far, we are not seeing any sign of reversal.
Okay, Aishwarya, but the FIs, they have been net sellers for this month as well. But we did see some traction that came in for the secondary markets because that has been their choice. And major flows have been pouring in into the primary markets. So what does this signal? I mean, is this a point of concern given the divergence that we are seeing in their choice, that the secondary markets have not been their choice, but the primary markets are where they're choosing to be?
No, so if you look at the reason for that being in primary market is not definitely valuations. Majority of the names that have come on the board, that's mainly the main board, things are not very cheap for them to go and put allocation there. So I believe majority of the money which is getting into primary market are long only structural flows, India based FIs who are putting the money in the primary market issuance. If we again look at how Indian market has done compared to various other market, I think there is a very, I would say, lackluster picture. If you see this YTD, Indian Nifty is up almost 4%. If we adjust it to dollar, we are roughly flat. It's at 0% return. Whereas emerging markets and many various other markets are up almost 24, 25%. US market, European market is up between 15% to 25%. China, Korea are up 30, 40, 50%. So there is a drastic underperformance of India, and the reason for that is possibly valuations, slowing down of earnings and the India-US relationship, which basically got into that difficult phase over the last year or so. But having said that, have seen all that, what now? We believe that the intensity of FI selling, even in the secondary market, is gradually going down. Obviously, we saw 3 consecutive months of outflows, but they were close to $2 billion, $2.5 billion kind of a number. Second is, if you really look at the biggest fear for this FIs to sell India was your earning growth taking a hit. When we saw the last quarter, we saw there was minor cut in the earnings. So we are going toward the bottoming of the earning cycle. And possibly after this quarter, there will be more kind of an probability of maintaining earning, or possibly we will be doing 19% growth for FY26. And this gets supported because of the kind of revival in credit we have seen for at least banks this quarter. and those GSTs and tax cuts and interest rate cut things which will play out. So I believe that I will not be surprised, Lovisha, that possibly by end of this calendar year, we will see the trend changing for FIs to sell India aggressively. Only area which can really derail it further is that if the India's and US relationships and all this tariff thing doesn't or accentuate further from here onwards, that could be the only caveat. But if that's gets settled, I believe FIs will look back to India in coming months.
Is betting on the global AI theme to play out. How would you see India in respect to this global AI theme narrative, where we are not receiving much of attraction compared to other emerging markets?
Yeah, so obviously India is, we have unfortunately not been an innovator, at least what are all digital that we have done so far is basically, understanding what's happening in other developed market and creating that blend here. Same goes for AI. Obviously, we are nowhere near close to any product which is or any company which comes to my mind. Obviously, we have been looking out for businesses who have done anything closer to AI. But I think for us, it has been the other way around. At least it has been, a threat to our Indian IT services in the form of the whole business model being disrupted. And we believe that, possibly every decade or so there is a new technology which comes and Indian systems will adapt to it, and we have seen from Y2K, from digital, and now AI, all these things will keep going. But we believe this is the change. This is something which is the completely paradigm shift which is happening in the whole global space. Even if you look at US, might be US has done superb performance for the indexes over the last in this calendar year. But if I look at the contributor to them has been more of this tech-led, AI-led stories, which has pulled up the market, which is not the case in India. That goes for Korea and Taiwan and things like that. So India has been a laggard, and there are a couple of one or two names which are closely doing work related to AI, but they are not game changer. And I think that is also one of the reasons that Indian market has not got die balls where money has actually flown out of India and parked into China and Taiwan and Korea and other regions where there are opportunities in this field.
Okay, okay. Aishwarya, let's come back to earnings. If we had to dissect second quarter, third, and fourth, what is the kind of earnings growth are you expecting from each of these quarters? All of these three that that I just spelled out.
So, like we are entering this quarter, I think the expectations are pretty muted, Louisa. I believe even if we do, the street is anywhere between 5% to 7% kind of a bad growth for Nifty 50 and almost 7 to 8% kind of a bad revenue growth for Nifty 50 stocks. When you look at some BSE 500 numbers, this is slightly higher by 2 3% because the broader market themes are possibly expected to provide much more impetus on margin there. But the revival possibly will happen from quarter third and quarter fourth, where we expect that earning growth should be in upward of 10-11% for the both of this year. Eventually, we will end up doing close to 10% kind of an earning growth, 9 to 10% for FY26. And a similar number should play out on FY27, though it's very far-fetched. But what is really important for us to understand that even if we do 5%, 6% earning growth, which market is expecting, we are suited well to complete or achieve those 9 to 10% growth in FY26. For viewers' interest in FY25, I think we did 5%. So there is obviously a reversal. What is really important more than that is whether we'll see more earning cut. And as I said, even the last quarter, we haven't seen more than 1 2% kind of an earning cut. And the expectations here also is that we will not see further cuts in earning, which believes the first steps in your earning growth trajectory when you see you are getting bottoming of the cycle and you see that revival happening. What really excites me, if you look at the way, suppose the Nifty, the 35% of this allocation comes from BFSI. And if BFSI is expected to do pretty bad this quarter coming through, where both private and PSUs are expected to see their earning go down between 5 7% year on year, primarily because of NIM compression of 10 to 50 pips and some, as cost-led pressure on pre-operating profits. But going ahead in quarter three and quarter four, we will see this revival happening. on account of BFSI, and that will be the much needed support for earning. Coming back to quarter two, there are very few sectors, Lovisa, which will possibly see some growth. Cement will be one of them. EMS could be one of them. OMC businesses will show good growth. And IT, pharma, FMCG will mostly provide modest number, 5 to 6% kind of in year growth. And as I said, BFSI will be laggard. Telecom will be one of them, which will lead the pack. So let's see how this result season pans out, but expectations are pretty muted.
Okay. Aishwarya, you did mention about the consumption theme that's where the street's focus has been. So we've seen auto stocks rallied quite a bit also in the past couple of sessions. Do you see more legs for rally ahead, especially into the second half of this fiscal year?
So I think these three things are beautifully playing out. First is the interest rate cut, which happened, CRR cut. Then we saw GST rationalization, which I believe is really not been talked about much, and this is a very big reform. And third is obviously the taxation benefit to many of those urban-led and benefit which will crawl through. And this is coming in surrounding when the petrol prices, crude prices are pretty good. So I believe this will bode very well for FMCG, consumer, auto specifically, primarily PV and two-wheelers. So we are very positive on auto. Obviously, we have seen that auto index, obviously in September also was one of the best performing, and many of these businesses, Heroes and TVS, Bajaj has done phenomenally well. PV players are still not getting that allocation toward because of the margin uncertainty, but that's not the case with two-wheelers. So we are of view that auto will continue to do well on the factors we mentioned to you about. And we don't see it as just a one-time phenomena on festivity. We believe this trend is more structural, that going ahead we will continue to see auto business, auto-led recovery to play out. Other segment apart from auto is we believe that consumer discretionary is one pie which will benefit out of the whole thesis. Could be consumer durables, it could be travel, it could be retail and clothing and all things like that. And we believe we are in a sweet spot. That's the reason we are saying that possibly we are at the bottom of the earnings cycle, because this early signs of demand being created because of all the reforms government has been bringing up, and alongside RBI making money cheaper and easier. I think we will be surprised to, or the market will be surprised to see the reversal in earning in quarter three and quarter four.
Okay. Into that all auto argument, how would you position yourself to the auto ancillary space? Because plenty of tariff heat has brought the sector under pressure. So would you say that you would go more domestic instead of the export-oriented players?
So I believe we are focusing more. At Trident we have a couple of names which are more domestic oriented. We believe the opportunity itself is huge here. So we are avoiding export led themes in Auto Inc. And that is also the one thing which we are very sticking to. So I think one paradigm shift which is happening in the market is that export oriented themes have been more of a sellers, where the shift is happening toward more domestic, more sectors which are more resilient, or financials, or possibly digital, and all sort of new age businesses where the money is moving through. So even we are very positive on auto. We believe we want to play it with more businesses which are more have an exposure to India specifically. That way we are pretty insulated from any dictate which can come from that side. 15, 20, 25%, 30% business of any of this large OEM and Auto Inc. To large global countries is manageable, but we are completely staying away from businesses which are primarily run or managed or sold in majority of these European markets, or US, has been the tough time for us or for everybody in the market. So that is why how we are playing in this. So we are playing OEM and domestic led auto ancillary. Only thing is the valuation is something which is becoming a bit difficult in auto segment. Even in auto OEM is the things have really pepped up really well in the last month or so. So valuation is one area which investors has to look very closely when they are putting the money in auto OEM right now.
Okay. Ashwini, you did mention about the cement stocks also that you're quite bullish on the counter as well. But how do you see the next phase to pan out? I mean, we are expecting good amount of earnings for this quarter as well from the cement space. But do you believe the valuations remain supportive enough at this point of time, or do you see that they have become a little bit of expensive?
No doubt about it. Cement has done relatively much better compared to other sectors. The reason obviously is that even in this quarter, when we enter, we'll see almost 15-16% kind of a volume growth, and the profit growth and EBITDA growth would be upward of 40-50%. But what is really has changed the landscape is the GST from 28 to almost 18. I think this is a big shift, and I think this positivity of this will be felt for at least 4 to 6 quarters going ahead. So that is what is really making market very excited about it. The second reason is, in spite of a very strong monsoon, and if I look at the way cement prices has held up in the last 2 quarter, there has been hardly a change of 1.5%, 2% across the space. So I think the stage is set, higher volume growth, decent pricing weaponry with them, and because of lower, GST benefit, and at the same time when government is spending on your infra and housing, I believe cement will continue to do well. And again, it's a more of a domestic story, so at least for the next 4 to 6 months it will be. One of the reasons we are not owning any of the cement stock in our portfolio, in spite of being very bullish, is the valuation, as you highlighted. So if we get opportunity in any of those small mid cap names in cement, that will be one area we will be very watchful of.
Okay, all right. Ashwini, you also talked about the banking space, but majority of the small finance banks, they've been seeing some, good pickup in the microfinance segment. So, on a larger perspective, how do you see the microfinance space at this point of time? Because we are seeing some improvement in collection efficiencies. So, do you believe that it's time to relook at the majority of the counters, given that they've seen and underwent a large amount of correction in the past couple of months?
So, Lavisha, this is a very, very interesting segment. And I tell you, we have been watchful about this particular segment. Uh, Over the last, I would say, 4 quarters, there has been a trend of some stability. I won't say there is an improvement in collection efficiencies or on asset quality parameters, but obviously there has been stability which is there. And when we look at historically, you make money in themes like this when you're able to catch the cycle at the right time. And my thesis has been that we are very positive on financials, especially NBFCs, but we are categorically avoiding micro lending as a space. The reason being is that we are not seeing a clear trend of social collections goes from 95% and then goes below 90 or 85. So we've been looking at various of these companies' data. That trend is not yet visible. And second thing is, in macro lending for any investors who's watching, you have to time it correctly on both sides because the cycle changes after every 1.5, 2 years or 3 years. So the area which makes us comfortable is that that cycle has been coming out of the blues. There is some kind of improvement which is visible, but still, I believe there is green shoots are still much, much far away. Uh, Second is there are very few limited players to play these theses with strong corporate governance and things like that. And FIs love this segment. Everybody knows it. This is FI's darling. So we believe, there is still at least a quarter or two of, I think, wait and watch mode for us. If we can see some kind of clear green shoot, we will play out the thesis. But right now, we are staying away.
Okay, staying away until a clear trend emerges. Aishwarya, let's also talk about insurance space because now that majority of the companies have shifted their focus away from ULIPs to non-linked products. And do you believe that there would be any traction that can we expect from the GST reforms? Because if you look at the insurance space, private lenders especially, they have seen good traction in the past couple of months.
Yeah, and I believe even in this quarter going ahead, they will be doing more resilient earnings. More than that, if I see the trend because of the whole changes in the landscape of regulation and GST, I think our insurance hits pretty decent from growth perspective. Majority of these players can pull up double-digit growth going ahead with, you know, I won't say revival in margin, but even the best stable kind of a margin over there. But at Fident, we are staying away from insurance. The reason primarily is that we believe First, obviously, the valuations are not really very comforting, both for life as well as non-life. And for financials, especially, we are more positive on capital market themes, given the way we are seeing money coming more in mutual funds and, whether it is custodian or exchanges or other areas. So insurance for us is being on the, much later in for our excitement about growth and all that. But we are watchful about it. And I'm not reading too much about that. Is there going to be a bank kind of an improvement in revenue because of all the changes and things like that? I believe money will continue to pour into, financial saving will happen more into equity, debt, and that kind of a segment rather than insurance. So that is where our excitement is or our focus is. So evaluation is obviously, if we see valuation giving us much more comfort, we'll play insurance in our portfolio. But right now we're again staying away here.
Okay. Aishwarya, just one last question before we let you go. I mean, IT earnings will be beginning this week. What are the factors that you're watching out for from the IT companies? We're expecting not much surprises for this quarter as well, but any key factors that you'll be watching out from the management commentary?
So expectations in IT are very muted. Much of the larger cap are expected to do anywhere between 0 to 1.5% kind of a CC. The currency has appreciated, so in INR term there will be a 2% cross currency positive impact. But mid cap, small cap companies will see possibly 1 to 4, 5% kind of a CC growth. Uh, so things which I will be looking out is two important things. Obviously, is the deal pipeline that this quarter will tell us a lot about how the US economy is facing through. If we see the deal momentum continues, and second, if we don't see any negative surprises on the revenue side, I believe market will find interest in IT going ahead. Second thing, obviously, is the management commentary. When I said I recently met majority of these IT companies, the commentary was pretty sanguine. They were not expecting any cuts or anything to worry about. Things were pretty normal. But if this commentary changes in the quarterly calls, possibly in this quarter, that will be one thing I will be closely watching too. But more than that, I think deal pipeline will tell us everything about how the situations looks like. And third thing is obviously the impact of Gen AI and AI. That is what I think the whole disruption around IT. That is the third area which we will be closely watching too.